Welcome, everyone, to the Information's TITV. My name is Akash Basricha. It is Thursday, May 21st. We are kicking off the show today with some exclusive reporting that the Information published around talks of a new chip deal between Anthropic and Microsoft. We'll then get to the monster Nvidia results. The company posted its quarterly results. It is expecting another big quarter ahead. We'll break that down with an analyst very shortly. The SpaceX S-1 is finally here. We have the numbers. We are going to get to the analysis. We are bringing on Ross Gerber very shortly, and we will wrap the show with some more exclusive reporting, this time around the White House's plans to review advanced AI models before they get released to the public. It's going to be a busy show, so let's get right on into it. The Information published exclusive reporting that Anthropic is looking to make a chip deal with Microsoft. My colleagues Aaron Holmes and Channer Liu wrote that story. Aaron joins us now to share with us what he knows. Aaron, welcome back to the show. What do we know about this potential chip deal?
So Anthropic is in early talks with Microsoft to use Microsoft's own custom AI chips, which are called Maya 200s. And the talks are early. It's not clear if this is going to actually lead to a commitment. But if they, do decide to rent the chips from Microsoft, this would be a huge win for Microsoft's in-house chip effort, which it's trying to prop up as a meaningful competitor to Nvidia, as well as to the in-house chip efforts of Google and Amazon and other AI players in the space.
So we've talked about a lot of chips on the show. We have not talked about the Maya 200 before. What is the Maya 200?
So this is the latest version of Microsoft's in-house AI chip. Microsoft has been working on Maya for several years, and this version specifically was delayed a few times. A lot of AI chips like Nvidia's are used for both training new AI models as well as running existing AI applications. But the Maya 200 is more focused on just running AI, which is also known as inference. Microsoft has said earlier this year that it started using Maya internally to run its Copilot tools, and that it found that it was cheaper to run Copilot using Maya for some tasks than NVIDIA chips. So, if it can convince customers like Anthropic that they could also run their models more cheaply on Maya than on NVIDIA chips, that could help Anthropic, unlock more compute, which it desperately needs right now because of all of the surging customer demand that Anthropic is seeing.
Do we have any sense around whether or not this chip is better or worse or comparable to Trainium or the TPUs that Google has put out there?
It's definitely a lot more nascent than Google's TPUs and Amazon's Trainium. Maya, as of now, doesn't have any big customers other than Microsoft itself. Whereas, Google has already been able to convince companies like OpenAI and Anthropic and Meta to use TPUs, and Amazon has similarly, said that some major AI labs are using Trainium. Generally across the board, NVIDIA is still seen as the gold standard for GPUs, but it kind of depends exactly which type of task you're trying to use them for. And I think that, winning a big customer like Anthropic would go a long way in terms of Microsoft's efforts to prove that these chips are the real deal and, are useful to major AI customers.
Were you surprised about this when you heard this? Because I feel like we just, put the Maya 200 aside for a second. I mean, chips were an area that I think we just haven't really talked about Microsoft around that much. And I think there was always a hunch that everybody's getting into the chip game. Everyone wants to be a little more vertically integrated. Microsoft probably would have got into it. But, it strikes me that if they get this Anthropic deal, this could mark a pretty significant turning point for its own chip ambitions in the long run.
Yeah, I mean, on the one hand, it is maybe, a little surprising to see a big lab potentially adopt the Maya chips, just because, to your point, we haven't seen that happen yet. But at the same time, Anthropic has actually always had this kind of agnostic strategy where they have, signaled that they're very willing to use any chips that they possibly can get their hands on. They were one of the first adopters of Google's TPUs as well as Amazon's Trainium, in addition to the Nvidia GPUs that they've always used. They're even in talks with newer startups about potentially using chips from those companies. So Anthropic very much has this philosophy of trying to diversify and not just rely on one architecture. And so in that sense, it makes sense that they might explore what that would look like from Microsoft.
Right, and that's kind of what I was trying to get at. It was, to what extent is this a reflection of how good Microsoft's chip is, and to what extent is this a reflection of just how desperate Anthropic is, or maybe how eager they are to diversify their chip supply? I mean, there is always a balance in that power dynamic. I want to dig into though the broader relationship between Anthropic and Microsoft. So, how does this fit into the cloud deals that they have signed together, and whether this could have an impact on that in the long run?
Yeah, so Anthropic and Microsoft have been getting closer and closer over the past year. Originally OpenAI and Microsoft were joined at the hip through an exclusive deal that made Microsoft OpenAI's exclusive cloud provider and gave Microsoft the rights to OpenAI's models. But they opened up that deal earlier this year, so now OpenAI is striking deals with other clouds, and we're also seeing Microsoft get closer to Anthropic. And at the same time, Anthropic has become a big customer of Azure in the last, 6 months or so. It has been ramping up its spending on Azure. I'm told that, inside of Azure, folks have been actively setting up new capacity for Anthropic and essentially saying, we need this capacity for Anthropic, so we can't give it to other customers, even some very big enterprise customers. And it makes sense. I mean, Microsoft wants to show that Azure is the place for AI labs to run their models. And at this point, Anthropic is the front runner in the AI race. So it's definitely in Microsoft's interest to keep growing and nurturing that customer relationship.
Great. Well, Aaron, I want to thank you for coming on. That is Aaron Holmes, our Microsoft reporter here at The Information. Nvidia had a blowout quarter with revenue climbing 85%. The chip giant also projected 95% growth in the current quarter. That would be the fourth consecutive quarter of top line acceleration. To break it all down, I want to bring on Frank Lee, Global Head of Technology, Hardware, and Semiconductor Research at HSBC. Frank, welcome back to the show. It's great to have you here.
Right, good to be back.
Okay, so what stood out to you from the results last night?
Yeah, so I think going into the print, I think it was a very similar setup as last quarter. We expected we'd probably see a beat and raise relative to where most consensus numbers was. But at the same time, I think we also highlighted, I think a few days ago that Nvidia would probably need to see more narratives emerging. I think earnings momentum and the next generation AI GPU roadmap wasn't really going to be enough. I think they really need to start focusing on a couple of new narratives, and I think they've started to do that with the reclassification of their data center revenue, which we think is a potentially big event because now they're breaking down the hyperscaler and non-hyperscaler revenues.
Yeah, so I want to go to that reclassification here. So it sounds like you think that that was a smart move, and you support it.
Yeah, I mean, I think if you think about the narrative going back to last year, Jensen Huang's talked about the enterprise and the sovereign AI for quite some time now, but it hasn't really quite materialized or very obvious in their numbers because they haven't really broken that down. And so I think now that they've broken down the difference between CSP and non-CSP revenues, it will be easier for the market to really track how they're doing on a non-CSP. Because if you look at the
CSP
CSP,
being for
I
those
mean,
who
the
don't,
hyperscalers. Yes. Yeah.
hyperscalers. Okay.
There's cloud service providers. Yeah. So, because if you look at one of the issues you're seeing this year is that that's more obvious is that the hyperscaler capex is now being divided by multiple people. So besides NVIDIA, memory guys are now eating into this capex. You're also paying for the networking, the optical supply chain. You're also looking at the server CPU now becoming a very big theme, especially with agentic AI. So more people are now competing for that pie. But if you think about the non-hyperscaler capex, this is still very much NVIDIA-dominated world, and that's I think where investors want to continue to see.
Hmm. So, tell us a little bit about this. So, the shape and structure then of these two segments. There was a question on there on the call about which one they expect to be growing faster, and also where the neo clouds would fit, if they would sort of fall into the hyperscaler bucket or the non hyperscaler revenue bucket. What was the answer to that question? And then we'll talk a little bit about how you expect these segments to grow afterwards.
Yeah, so I think for the most part, everyone else outside of the 4 or 5 major hyperscalers are gonna be in a non-hyperscaler bucket. So that includes, I think the neo cloud guys would largely be in it. In fact, if you look at the last couple months, NVIDIA share price has had a bigger move on the back of the positive bullishness around the neo clouds demand rather than its own earnings, beat and raise last quarter. So I think that's a sign that the market's looking for more growth opportunities to come from these non-hyperscalers.
And so you're expecting, and the company, the Nvidia themselves, they're expecting that second bucket, the non-hyperscaler bucket, that is going to be the big growth driver for them. Well, not maybe not growth driver because hyperscalers are so big, but that will be a faster growing segment. Is the point?
Yes, I think that's what they're being alluded to, and I think that is probably gonna be a more meaningful, narrative to help re-rate the stock, than purely just its own earnings momentum by itself.
So then I want to go back to what you were saying at the start is you said the company was looking for its new narrative or its next narrative, and this reclassification being part of that. I mean, is what would be that narrative? I mean, companies outside of the hyperscalers, I mean, I get that. Look, you could say that enterprises broadly are turning to us, the neo clouds are turning to us. Is that enough to move the needle here? Or, what do you think it actually takes for the stock to move even higher? Because it didn't really move on the results last night.
Yeah, because excuse me, I think if you look at the split right now, the data center revenue split is now almost 50-50 between the hyperscalers and the non-hyperscalers. So I think if we see the non-hyperscaler portion continue to rise and exceed 50%, that would be a pretty positive indicator. The other thing I think as a second narrative is this focus on the server CPU, especially with the attention being paid this year to agentic AI. This has been basically an area that NVIDIA is now pushing more aggressively. They talked about potentially 20 billion in revenues from the server CPU itself. Now, I guess the pushback though would be 20 billion for Nvidia is not a huge number. I mean, it's crazy to think, but given how big their revenue already is, so I think there's still some debate about how meaningful the server CPU could be to its overall business. But it is an area that I think the management understands that the market is quite focused on right now.
And so I just want to come back to making sure people understand how the results are reported. CPU revenue, server CPU revenue, where would that fall in that reclassification now under the current structure?
Well, yeah, it's a good question. I mean, I think it still falls under compute. Now, how it breaks down, I think you'll see basically CPU revenues both in the hyperscaler as well as the non-hyperscaler, especially if they sell standalone. So that, I mean, they pulled out a number of, excuse me, of 20 billion, but they haven't really, in terms of where it classifies between that, I think you're going to see CPU revenues in both types of customers.
Do we lose any level of granularity with this new reclassification? It's always kind of a tug of war, right? Like you get a little bit more clarity in one sense, and then you lose some detail in the other way. Is that a concern at all for you?
I think I mean, NVIDIA itself
It
is also getting much more complicated in terms of reporting, right? Because it is moving beyond just a GPU revenue company, right? It's becoming more system oriented. So I think the way they have been reporting wasn't going to be fully reflected anyway. I think the end customer base is what ultimately is becoming a more important driver. So I do believe this is the right direction for them.
Hmm. The other thing that came up on the call last night is CFO Colette Kress. She talked about rental prices for older NVIDIA chips, and she mentioned that they had actually come up. What do you think is driving the increase in those rental prices? Is it just the GPU crunch broadly? Is it customers saying that, hey, maybe we don't need the latest and greatest, we can make do with the Hopper family or the A100s? What do you think was behind that?
I think excuse me. I think ultimately what you're saying is that sorry, is that you're still seeing demand is just still outstripping whatever supply is out there. So the compute demand is still exceeding most people's expectations. So I do think that is why the rental costs are still going up. We've seen that already from the neoclouds have been talking about that in the last couple of months as well. So it still paints an overall picture that there's just not enough compute demand out there. But I do think one other thing that's interesting is the supply side bottlenecks continue to diffuse out to more and more places. So one thing I think that another narrative that Nvidia has talked about is all these recent deals on the optical side. If you look at these deals with Coherent and Lumentum and Corning, these are all meant to secure the supply side on the optical side, which we think will be a very big driver. And so I think Nvidia agrees with that, which is why they want to make sure that they have enough supply there.
Can you explain that a little bit more for people who don't follow optical as much? Just unpack that a little bit more in layman's terms.
Sure. So as you see these data centers build out, one of the bottlenecks is really, the bandwidth, the speed has to get faster and faster. And one of the things that's driving that is the optical demand. This is going to be, we're going to move from copper to optical, and this is going to create a significant amount of demand to help improve performance. So it's not purely just based on the actual computing power of the chip. It's a much more full system integrated, and that includes the networking piece. Right. So NVIDIA has been moving there already with its Mellanox. But in addition to that, they got to make sure the rest of the supply chain is there with them. For example, if you look at memory, this has been a big bottleneck, and they have done a lot of things to make sure they have secured enough memory capacity, given the tightness we're seeing. They're just extending that to another part of the supply chain.
Got it. So when you say optical, you're talking about the networking products that NVIDIA has moved deeper into.
Yeah, like they're basically the transceivers that goes into the backbone in terms of providing the networking bandwidth, both for scale out and scale up.
Right.
You're going to need a lot of networking for that.
Right. Um, a couple other questions for you. So, Vera Rubin, the new family of chips, when you talk to channel partners or people in the orbit of customers, et cetera, what are they hoping for out of this new family of chips? And how confident are you that NVIDIA can deliver that?
Well, there's always potentially a concern that whenever you have a new ramp, there could be some, potential issues in supply chain. There has been some potential concerns about memory not catching up, or at least not quick enough. But we think there's going to be relatively short term. At the end of the day, I think Nvidia is still pushing, performance based. Rubin does increase performance, but that also brings up another question: is that we're seeing some competition from the ASIC side, especially Google's TPU. We've seen a lot of very strong momentum there, which is why I think the market is looking for them to extend their customer base. Because I think if you look at neo clouds, right, they're not going to be moving into the ASIC side, so they're going to be very much within the GPU camp. So I think a lot of that Rubin demand will also go into these non-hyperscaler customers as well.
Great. Well, Frank, I want to thank you for coming on. That is Frank Lee from HSBC here on TITV. SpaceX's IPO filing is officially out. It was a document that Silicon Valley, markets, the whole world was waiting for in some cases. There was a lot there. And so to break it all down, I want to bring on Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, welcome back to the show. It's great to have you here.
Great to be back.
So SpaceX's IPO filing, there's nice photos in there. I mean, you could make a little
Amazing.
coffee table book out of it, maybe.
Yeah, for an S-1, it was the first S-1 I read with pictures.
Yeah, yeah. Um, so I mean, look, we'll get into it, but high level, better or worse than you thought?
Um, I kind of knew most of the information, to be honest, because Reuters had gotten a hold of this somehow earlier, and so I kind of knew.
Oh, and I should say we also had a number of the
Okay,
file
so
of
not
financials
several media
ourselves.
outlets. So
But
because
the
of my
information also reported a lot of it. Yeah.
Yeah, so because of my relationships, I kind of had some of the information already. What I thought was really interesting was the way they laid out like their business plan, because it's really a three-pronged business. And I think a lot of people are really focused on like financial numbers and all the stuff that came out, like how much money XAI is spending on servers versus the fact that Starlink, for example, is a wildly profitable, successful business. Space launching is also not per se a bad business either. And so when you see the vision laid out, the three prongs of the vision, which is really about, first, connectivity through Starlink, and then secondly, this, space data center things which would bring ideally down the cost of compute substantially, but also be a connection to further life outside of Earth. It's kind of this crazy vision. But somebody's got to do it. I guess it's Elon.
So there was nothing in there that surprised you, really?
Not surprised me. I think the one thing that I didn't really, I guess, understand is clearly, and I recently met with a lot of SpaceX employees because we're working with a lot of SpaceX employees at my firm, and you see different parts of the vision, but the way the S1's lined out, you see this like grandiose vision of the future, and really this idea that humans could be like extinct, and so he wants to create this like colony somewhere else so that we'll never be extinct. I'm more in the camp of like, why don't we just like save the Earth we're on now versus trying to live somewhere else? But certainly Elon and SpaceX's vision is massive. So that's the part that surprised me.
Right.
It's just like, wow, like 1 billion people living on Mars. Come on, I can't get 1 million people to move out of LA to somewhere, else. It'd be great.
So let me ask you this: Do you recall when the Tesla S1 came out? I think it was 2010. Was it? Do you remember reading through that document?
I mean, I kind of remember I remember the IPO because we watched it. And but at that time I wasn't like that into Tesla. Like somebody brought it up to me and I knew of it. And so I didn't actually care that much. But once it went public, it was actually the Model S, which rest in peace, died yesterday. They had the funeral at Tesla yesterday online, and which I couldn't watch because I was so sad, because that was the vehicle when I saw it, I knew Tesla had something very special, and so, it's a very different experience because Tesla was like a $3 or $4 billion company. It was a startup, and we were betting on something new. SpaceX is a very well-established multi-trillion-dollar company that now, in its maturity, is giving investors an opportunity to get involved with. Now, I was lucky enough to get into the SpaceX investment through my investment in Twitter many years ago. So I'm happy to, at full disclosure, I do own SpaceX. So I'm excited about this stage. But what I'm most excited about actually is somebody actually has a grandiose vision in America. Like, you can't get somewhere if somebody doesn't try. And I don't necessarily believe we're going to be living on Mars or not. That we can debate that for the next several decades. I ask my kids. My kids are like, why would anybody want to live on Mars? Like, humans don't do good with no gravity, it turns out, things like that. So, but I think space as an actual place, it's like a new sector. And this sector, in what I've learned, has enormous opportunities. And so you can look at this grandiose stuff, or you can focus on the stuff that's real, which is, how much weight they can bring into space on an annual basis to put up satellites and put up actual infrastructure in space. And that number is growing exponentially. We have a launch this afternoon, Starship launch.
Hopefully it goes. Hopefully
it'll go. The question is like, how far,
Yeah. Yeah. So I do want to talk though about, you mentioned what's real. And so there were a couple numbers in the filing that were interesting. Specifically, the numbers I'm thinking about are the ARPU numbers, the average revenue per user numbers for the Starlink business. And, we saw that those numbers have started to come down, even despite the number of subscribers having gone up. And look, I think,
but that's also because of the Starlink Mini.
Right.
Like I have 2 Starlinks. One I pay 120, the other I only pay 50 because it's the Mini.
Right. And so I think there's a good understanding out there as to why that's the case. My question is, do you expect those to come up? Do you expect those to continue to come down? How are you thinking about that figure?
Because it's kind of like a new business, and I find their price point to be very competitive compared to like normal internet, and Starlinks are a lifesaver. It saved my life in the Palisades fire in a lot of ways. Like, we were stuck for 3 days without any communication, and without Starlink, it's winning the war in Ukraine. So we can't underestimate the value of Starlink and what will eventually be charged to customers. It seems like they're bringing down prices to really just be competitive, because they're their margins are huge at Starlink. So, once they get it up there in the sky, it's a very profitable system to run. So Starlink is clearly the profit monster of SpaceX. And so what I think the real question is, can they like double, triple, the amount of subscribers, and maybe rates go down a little bit, but you've still got a rapidly growing business that's highly profitable. So that's definitely the queen of the crop of businesses inside SpaceX as far as from profitability perspective.
Now, the other thing that was interesting was the lockup period for the shares here. It's shorter in some cases for some employees than the 180 days that everyone has been traditionally used to, and my sense is this is becoming a little bit more common for tech companies. It wasn't always the case, but what did you make of the language around the lockup period, and then we'll talk broadly about whether you think this is going to change in the long run.
I think it's a byproduct of the just lack of supply of IPOs in America, where companies can like do these things and investors will take it. I mean, the first page of the S-1 is just absurd. It's basically like, this is Elon Musk company. Texas has a rule, like you have to have independent directors. That's all thrown out the door. It's called a controlled company. It's like flat out, Elon will do whatever he wants. You are investing in this on whatever terms he wants. If not, stay away. So these lockup periods and all this, he doesn't care what anybody says. He's going to do whatever he wants to do. And if you don't want to be a part of it, don't be a part of it. And that's the attitude of SpaceX. So they're going to do what they want to do, and they're going to let their employees have liquidity sooner. And I don't per se have a big problem with that as an investor, as long as it's disclosed. People know this, and a lot of liquidities. We're working with these employees. I'm telling you, a lot of them have been there for 10, 15 years and waiting to, get a little money to, guarantee their future. And we're working with these people, and there's a lot of them. So, it's hard to predict the supply and demand dynamics of an IPO, but I know the demand is also really high for shares. So, this is going to be a fun time. It's going to be a very, I think, record-breaking IPO in almost every way. Sadly, it reminds me a little bit of the AOL Time Warner merger, with all that euphoria in the late 90s that I lived through. And we're starting to see a little bit of that with SpaceX. So part of that's good and part of that's bad.
Why do you draw that? I mean, go deeper on that connection. Why?
Because, we want markets to function without too much emotion, okay? Like, markets can go pretty out of control, bearish or bullish, depending on sentiment, in human behavior. And we're getting into a stage in the cycle where there are many things that are concerning, like higher rates and inflation, which could actually really hurt the economy. But yet our economy is just like booming right now, despite these things. But it doesn't last forever. And so what happens is you get a lot of euphoria about a big IPO like SpaceX, and then you get Anthropic and you get OpenAI, and next thing you know, you got so much new stock in the market. It's just a function of supply and demand. It puts too much pressure on the markets to absorb all this stock and still own Microsoft, Apple, and everything else, right? And so investors, like, the biggest risk is to Tesla. Tesla seems like a really boring company next to SpaceX. I'm sorry. It's just like, we're making robots at some time in the future, and we're making cabs that don't work, compared to like data centers in space, So, people like our clients might want to sell some of their Tesla to buy SpaceX. And so you get this.
But so let's go back to what you were saying though about, so rates are what they are. The broader story here is SpaceX is a story that really only succeeds in this sort of frothy period where people will take chances. And so I guess the question I'm asking is your perspective on the bubble at large, given that I think we saw.
Well, I don't think we're in a bubble at the moment. Yeah.
So, I mean, when you see the 30-year Treasury at 19-year highs, for example, what does that say to you about things?
Says I'm going to buy some of those today, probably, because, if I can get over 5% guaranteed for my clients, who are retired, and they take out 4% a year, it means that they're guaranteed to continue to get good income. You can buy, like, we were looking at Meta bonds pay over 5%, on a 10-year. So, like, we actually don't mind a little bit higher rates, because we locked in these rates for our clients and they live on this money. When rates are zero, it's real hard. What I'm worried about is the fact that our government is running massive deficits. We're in a war. We have over a trillion two on the budget just for interest and going higher and higher and higher. And it seems like nobody wants to, believe that at some point you have to pay for all this. And that comes from taxes and for benefits and Social Security and blah, blah, blah. But, at some point, this does come to roost. And that's my concern as an investor with higher rates. And look at the real estate market. It's sucked for like 5 years and it's going to continue to suck, if we don't.
So eventually it could hit the equities market
No, it will, because so we've got this weird cycle now where a ton of infrastructure is being built in the United States. So there's tons of jobs. Like, I keep saying, if you can hammer, you got a job in America today. Like where I live in the Palisades, they're rebuilding. There's 1,000 houses being built right now. Like it's booming out here. Like it is booming in California right now. So so we got this weird thing. So what I'm worried about, you get all these IPOs, you get the market too frothy, you get a PE ratio on the market that gets up towards the mid 20s, gets high in the forward PE, and now you're in a bubble. Right now we're at the cusp of that, so SpaceX could be the beginning of the end, or it goes out and things stay reasonable rate, then I'll be happy. But if we see a lot of IPOs and a lot of froth and the market moving to 8,000 and all this stuff, boy, you got to be a prudent person.
And so last question for you then, Ross, are you going to buy more SpaceX when it goes public?
Well, I own a pretty decent amount personally.
Okay.
The question is, do I buy it for my clients who don't own it? Our policy at my firm is we typically don't buy IPOs right when they go public. It's a very hard game. Most of the time you lose.
I think that's a good smart policy.
Yeah, so we usually wait 6 months because we want to see the lockup expire.
Yeah.
We want to see, like, I just bought this stock, Carmen. It's a rocket maker. It went public a year ago. It rallied up. Now it's come back down, and then it kind of finds like what's the real value. And I think with stocks like SpaceX, for example, a good $1 trillion of value is just like Elon. You know what I mean? So like all the people online are like, oh, it's 100 times revenue and da 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 da. But I'm also like, it's not really. The core business is worth 500 billion. That if I was running, it'd be worth 500 billion. But it's Elon, so everybody gives him $1 trillion. They give $1 trillion of value at Tesla, and now they're giving $1 trillion of value in SpaceX just because it's Elon. So God forbid anything happens to him. That is the biggest risk to SpaceX. So they have no succession plan, and they have no future if he dies. So this is a huge risk. So in a year, maybe 6 months, we'll look at the stock for clients and see where the value is. I'm sure it'll rally on the short term, but where it will be in a year, we'll see.
Great. Well, Ross, I want to thank you for coming on. That is Ross Gerber from Gerber Kawasaki here on TI TV. The White House has postponed an announcement for later today that was expected to be an executive order on how AI companies should engage with the government around AI models. My colleagues Leo Schwartz and Stephanie Palazzolo had exclusive reporting about that order yesterday. I want to bring on Leo to share with us more about what he knows. Leo, welcome to the show. It's great to have you here.
Great to be here. Thanks, Akash.
It's your first time on the show, and you're going to be on more and more because tech and politics is the topic to cover, as evidenced by this news today. Tell us about what we were expecting to happen today, and then we'll talk about what the order was supposed to be.
Yeah, this has been a wild news cycle around this planned executive order out of the White House on AI. Rumors started swirling about it about 2 weeks ago. There was fears that this executive order could actually create a mandatory system in which AI labs would have to get clearance from the government before releasing new frontier models like Anthropic's Mythos. That was later pushed back to say it would be more of a voluntary system. Yesterday, Stephanie and I reported exclusive details about a briefing that the White House had with different AI companies and financial services companies about what would be in the order. And at the time, it was expected that the order would be signed this week. Now we just found out that the signing, which was scheduled for later today, is postponed, which just reflects how fast-moving the story is.
So I just want to understand what your understanding was of what this executive order was supposed to be. I mean, we know that we have these these dangerously good models, Mythos, these types of models that are being developed in some cases. Was the guideline from the government that, hey, you have to run it by us before releasing it? Was it more of like a nudge? Like, what was the substance of this executive order supposed to be?
I think it's important to take a step back here and just give some context, which is that under the Biden administration, there was more of an understanding that the executive branch would create some sort of system for making sure that AI labs would have to get some sort of clearance from the government when they're releasing new models. Under Trump, who has a more hands-off, light touch approach driven by his AI and crypto czar David Sachs, they said that idea is anathema to our policy, which will be let them cook, let AI companies develop their models without any interference. There will never be any sort of licensing system. Then fast forwarded to early April when Anthropic announces Mythos, this new frontier model with huge amount of capabilities to detect cyber vulnerabilities, which they said was too powerful to release to the public. That triggered a shift in the White House where you started to have these new voices coming in from the national security side and said, maybe we should rethink this idea of having some sort of licensing system, some sort of more mandatory clearance system for AI. And over the past few weeks, there's been a divide within the White House on whether there should be a voluntary system or a mandatory system. Our understanding is that what won out in this new executive order is more of a voluntary system where AI labs would work collaboratively with the government to say, hey, we have this new model. Here's what it could entail. We'll help you figure out possible vulnerabilities that it could detect. But it won't be a mandatory system. There'll be nothing that labs have to do with the government to be able to release new models.
So it sounds a little squishier in practice than as to who is actually supposed to, get in touch with each other and review these things.
I think this is always the question with executive orders, which obviously will have less of a mandate than actual legislation. I mean, in this case, even more so, what does voluntary mean? I think the White House has said over and over again that companies like OpenAI and Anthropic have been working collaboratively with them on this. Obviously, there's not going to be a near future in which Anthropic rebels against the government and says, we're not going to work with you on trying to figure out what the risks of new models could be. But under this new order, it is voluntary, and it remains unseen what would happen if a company, maybe a foreign company, said, we don't want to submit to these guidelines.
Right. But I mean, thought about another way too. I mean, ahead of the midterm elections, the White House gets to say, we put the order out there. I mean, we are protecting society from the risks of AI. Meanwhile, the AI labs, the people who have a stake in this too, they actually don't really need to do any, it's voluntary at the end of it, like you said. So maybe this is a way to sort of appease both sides.
It definitely does seem like, in some sense, a bit of a marketing campaign. I mean, I know there's a lot of fears about the backlash against AI among the public, obviously among voters.
And
In this case,
students and new grads. We've got the
students
commencement
booing
addresses.
booing poor Eric Schmidt, I believe. But yeah, it does seem like under this order, it will create a framework for companies to engage with the government, which is important. And it's important to note that companies like OpenAI and Anthropic have been doing this since the Biden administration under a small agency within the Commerce Department. There's also another half of this executive order, which is basically building up different capabilities within the government to detect cyber vulnerabilities, to create a clearinghouse under Treasury that would basically work initially with financial services firms to try and figure out how to shore up potential risks. So this does seem like holistically a good approach to how to deal with the risks of models like Mythos. But as you said, because it's voluntary, we'll see if it does lack teeth in the future.
Now, the other half of your story that was really interesting that I want to ask you about is who is really running the AI strategy right now within the government and within the White House? You mentioned David Sachs earlier in our conversation. His term under that position, I believe, that ended in March, right?
Yes, that ended in March. He was a special employee, which had a limit to the amount of days he could actually serve in government. When that ran out, Trump appointed him to this executive council with a bunch of CEOs of top tech companies. But by all accounts, he became a lot less involved, or at least had a lot less control over the administration's AI policy. That coincided, of course, with Anthropic's announcement of Mythos and a lot of new voices from within the administration starting to pay attention to AI for the first time and saying, I think we need to maybe have less of this hands-off approach that Sachs championed and start to explore ideas that were previously very unappealing to the Sachs crowd, like this idea of having some sort of clearance system. And while that didn't win out, it's clear that currently there is a bit of a divide or a turf war within the government to figure out which agencies and which voices should really have control over these incredibly powerful new models, or at least control over regulating these powerful new models. You're starting to see new acronyms, new agencies come into the fray, as evidenced by the fact that the agency who it seems was leading this order and who hosted the briefing on Tuesday for AI companies and other companies was the Office of the National Cyber Director, which falls under the White House, not the Office of Science and Technology Policy or other historical offices who had more control over AI.
Right. Well, it's going to be a story that moves quickly, I'm sure, and a lot of different characters involved. We are excited to have you here with us, Leo, to help us make sense of it all. That is Leo Schwartz, the information's technology and politics reporter here on TI TV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to subscribe to us on social media, on X, Instagram, and TikTok, also on LinkedIn. I'm already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.